Hello and welcome to this online seminar where I'm going to be looking at the pensions and tax efficient investment reforms made in this year's Finance Act. My name is Chris Jones. Firstly, let's turn to the pensions reforms. These rules are pretty revolutionary and they affect all defined contribution or money purchase schemes and allows much greater flexibility. There have been some interim relaxation of measures from the 27th of March of this year, with full relaxation coming in from April of next year. And once that full relaxation comes in, are we really looking at a pension scheme at all, or are we actually just looking at tax efficient savings for elderly people? Now, this is going to be a key area for advice because clients will need to know what they can and can't do. And one of the difficulties, I think, is what are we going to advise? Because there's obviously the tax rules. We could work out what the tax charges are. They're going to be obviously a lot more flexibility. But when we're giving advice here, we're actually looking at, well, what do the individual need to live on in their retirement? How long are they likely to live? I'm likely to find that out this afternoon because I'm off for my annual medical, so that will certainly affect how I might draw down my own pension. The only thing I don't feel healthy about is the fact that I haven't been able to drink caffeine all day, so really struggling now at about 20 to 1 in the afternoon. So, we'll have a major knock-on effect on tax advice, and around 90% of people in the UK don't have more than £40,000 in their pension pot. So as we can see, these rules are going to affect a lot of people. So let's turn now to the drawdown rules on pensions. The maximum drawdown on a pension is going to be increased from the previous 120% of the government actuaries tables to 150%. So let's just think why the rules were introduced in the first place. That basically, if you've got your main pension fund and you want to start, instead of investing in an annuity, instead you want to draw it down from your own fund with the flexibility that means that if you die before you've drawn down all of your fund, you can then leave the rest of that fund to your nearest and dearest. Whereas if, of course, you bought an annuity, it just stays with an insurance company to fund people's pensions who've lived longer than you. So you literally are turning in your grave. But in order to stop people just drawing down and feasting on their pensions, then being left for the state to sort them out when they run out of money, they're now basically introduced a rule that originally that said you couldn't draw down more than you could have got if you got a normal sort of annuity. Now what they're saying is you can actually draw out 1.5 times what the annuity would be, because essentially the government actuaries tables are similar to what you get as an annuity. So not only is your decision on whether you invest in an annuity or you decide to draw down based on, the tax rules, but it's also based on how much pension you want. Because if you want a bigger pension, then you're better off doing a drawdown, but you do run the risk of the money running out one day. Now, flexible drawdown is available to those with sufficient other pension income where you've got complete and utter flexibility. If you have other pension income of at least £12,000 gross in the year, i.e. £1,000 a month, from another fund that's guaranteed for the rest of your life, you can draw down off other funds as much as you like and take a whole lot out. The only thing is you just pay tax on that amount. So that's also increased flexibility, because prior to these changes on the 27th of March, the amount that you actually had to have from other pensions was 20 grand. That's now reduced to just 12. Now, the other thing to bear in mind is what tax charge you'll actually get. And the tax charge now used to be a draconian charge, but now you simply pay on your extra drawdown tax at your marginal rate. This is a very clever change that the Chancellor introduced here, because in the past, if you had actually been subject to, for example, you're going to take your extra drawdown and you'd actually be subject to a 55% tax charge, you'd think, there's no way I'm going to draw it down, and therefore the Chancellor wasn't collecting much tax off that because it was a draconian charge. Now the Chancellor saying, we just add it to your normal income and you're paying tax at, say, 40 or 45%. More people are going to do it. And if more people do it, the Chancellor will actually then get more money in. So he's actually going to get more money in by reducing the tax rate, because more people want to do things. So whenever we think, the only way to actually raise tax revenues is to increase tax rates, sometimes reduce it to actually encourage activity that becomes taxable. Clever. And I don't normally say that about the Chancellor of the Exchequer. Let us now turn to the commutation of pension rights. This means that you can take a cash lump sum now and essentially pay tax at your appropriate rate of tax, whereby the amount of tax that you'll pay will be 25% of it will be tax-free under the normal rules because they're approved pensions, and the balance at your marginal rate of tax. So say that will attract that type of activity. Now there will be trivial commutation rules where your total pension savings do not exceed £30,000. So there's a lot. If 90% of people in the UK have got no more than 40,000, there's going to be still a lot of people out there of pensions of no more than £30,000. So this will actually allow that greater flexibility. They're also changing the rules that relate to small pots, where total pension savings are more than £30,000. You can take out a chunk of 3 lots of £10,000 as extra amount, again taxed at your marginal rate. First 25% of course is tax-free, rather than in the past, you actually had a limit of 2 years and only £2,000 a year. So increased flexibility, more people able to take more money out earlier, pay their tax earlier. The Chancellor gets more money in, so he's happy, but individuals get hold of their pension money earlier, so they're happy too. And you can't get better than everybody being happy in this lovely equation. Let's now turn our attention to the lifetime allowance. The lifetime allowance has now been reduced yet again in this year's Finance Act, and that is going to be reduced to 1.25 million effective from the beginning of this tax year. And if you wanted to have fixed protection of that fund, you had to notify that before the 6th of April of 2014. And I do remember lecturing about this in my season of lectures on our CPD seminars, reminding people to get those elections in. If, however, you haven't got your FP election notice in, it all is not lost, because you can now elect for a new individual protection for 2014, and you don't need to notify that until the 5th of April 2017. It's not available if its primary, fixed or enhanced protection is taken, but at least there is some protection available, and that protection is based now on what they call the relevant amount. And I would advise you to have a look at this in some more detail, either in the legislation, the yellow and orange, or have a look at it in the notes that support this month's lecture. I'm going to attempt to take you through how you calculate the relevant amount, but you certainly won't remember it. It is something you really do need to refer back to the notes. So this is taken really from the legislation. The relevant amount is the sum of amounts A, B, C and D. And A equals the value of your pre-2006 pensions in payment. B is the value of any pre-6th of April 2014 benefit crystallisation events. C is the value of uncrystallised amounts in the pensions as at 5th of April 2014. And D is the value of uncrystallised amounts in relieved non-UK schemes as at the 5th of April 2014. You still with me? I guess not, but let's carry on nonetheless. So, individual protection is available if the relevant amount is greater than 1.25 million, and if the relevant amount is more than 1.5 million, then the amount that you can get, the amount of your relief, your standard lifetime allowance, will be the greater of the SLA and 1.5 million, but otherwise it's the greater of the SLA and the relevant amount. So, best thing to do is to pass that over to pensions advisors if I were you, or have a look at Pensions World, because that's something that we cover on our online service and our magazine distribution. But people called actuaries, who are people that started life as tax professionals but found that far too exciting, became actuaries, they'll be all over this sort of stuff. Okay, finally in this lecture, I'd like to look at the Seed Enterprise Investment Scheme, because these are absolutely brilliant. They do work really, really well. And you'll be pleased to know in this year's Finance Act, the Chancellor did not make any particular changes to it, but the key thing is he's made it a permanent relief. It was going to expire in the future, but the Chancellor now made it a permanent feature of the tax system. The CGT reinvestment relief has also been made permanent. So not just the income tax reduced you get up front, but also the reinvestment relief, and that is going to be effective for 2014-15. And I thought, as the scheme is so useful, I thought I'd end with an illustration of how the scheme works. So an individual is allowed to invest up to £100,000 of their hard-earned pennies into a company that meets the SEIS criteria. It's a small start-up company. It's been going for no more than 2 years and has a fairly low level of assets. So it's a proper true start-up. So a pretty risky business to invest in, because start-ups always are. But the nice thing with risk, of course, as we know as advisors, the greater the risk, the greater the reward, potentially. But of course, the greater the risk, you could lose everything. So let's have a look at this, how you talk somebody into this type of investment. So you've got your £100,000 to play with, and immediately the government will give you half of that back, assuming that you have at least 50 grand's worth of tax that you owe in a year, because if you haven't got the tax, you can't get the reduction, clearly, but assuming that you're paying at least 50 grand's worth of tax, you'll get that taken off your next tax bill. So the amount you'll invest in 100 grand's worth of shares, the company will get 100 grand of your money and be able to spend it on developing their business, but it's only cost you 50. Then let's say that the way that you raised that money was to sell another asset in that tax year, and that created a capital gain, then you are able to exempt 50% of that gain. So let's say you sold a buy-to-let property, you've got a gain of, say, 100 grand on the sale of that property. Half of that becomes exempt. So instead of paying CGT on all of that gain at 28%, you only pay CGT on half of it, thus saving you £14,000 worth of CGT. So let's have a quick recap. The company's got 100 grand of your money, and you've actually got £64,000 off your tax bill if you're able to claim the CGT relief as well. But of course, we're accountants. We are trained from an early age to always look on the black side of life. So forget Monty Python. We also have to look, well, what if the worst happens? What could happen here? Well, of course, I invest my 100 grand in this company. It's a complete dog of a company. It goes nowhere, collapses, and I lose the whole lot. That's the worst that can happen. So what would happen in reality? Well, provided that investment is kept in there for 3 years, at some point in the future, I will make a negligible value claim to HMRC, and I'll have deemed that I've sold these shares that nobody wants, of course, back to myself for zero. So effectively, I will crystallise a capital loss. And you're thinking to yourself, well, yeah, what good is that? If I haven't got any capital gains arising in the future, I can't really use the capital loss, and that's absolutely correct. But of course, the clever bit is that because this is an EIS company, I will be able to elect under Section 131 of ITOIA to convert that capital loss into an income loss. And assuming that I'm continuing to earn good amounts of money, I'll be able to then crystallise that loss and set it against my other income. Okay, how much is the loss? Well, if we go back to what we looked at, I've actually invested 100 grand, but it's only cost me essentially £36,000 because I've got 50 grand's worth of income tax relief and £14,000 worth of CGT relief. But this is the clever bit, and this is perfectly legal for anyone listening to this, especially Margaret Hodge, because this is what the legislation says. Although my actual loss, if I've claimed the CGT relief as well, is 36 grand, my tax loss is 50 because you don't include the CGT bit when you're working out a calculation of the loss. So I actually crystallise a loss of 50 grand. If my marginal tax rate at that point is 45%, I get 22.5 grand of that money back. So actually, it's only cost me £13,500. So, if somebody says, do you want to put 100 grand in my company, and the worst thing is that, that you could lose 13.5 grand, but the best thing is that that company really, really did well, you could get huge amounts of gain in the future. You could be investing in the next IBM, for example, or the next Reed Elsevier, who knows? You end up with this huge amount of gain later, which is tax-free because the SEIS rules apply. If by later on the Chancellor seeing fit to reduce the 45% tax rate to 40, well then it still only costs you 16 because your loss you crystallising is only relieved at 40%. But nonetheless, 16 grand is still not a lot to lose, bearing in mind what you might be able to gain. Of course, in order to advise on what particular schemes to advise in, you need to be a registered investment advisor. But at the end of the day, the tax breaks speak very much for themselves. Well, many thanks for listening to this online lecture on the changes to the pensions and tax-efficient investments in the Finance Act of 2014. My name is Chris Jones, Director of Tax Markets at Tolley.